Let's explore this relevant cost analysis problem that deals with a variety of different situations. Andretti Company has a single product called a DAK. The company normally produces and sells 60,000 DAKs each year at a selling price of $32 per unit. The company's unit cost at this level of activity are given, and you see it in the table here. So we've got direct materials at $10, direct labor at $4.50, variable manufacturing overhead $2.30, and remember this is unit cost, one level of a DAK or a DAK. Fixed manufacturing overhead comes out to be $5, so $300,000 in total. $1.20. Fixed selling expenses of $3.50, and that's $210,000 in total. So a total cost when we add those up of $26.50. Okay, and then we've got a number of questions to analyze. So the first requirement says, assume that the company has sufficient capacity to produce 90,000 DAKs each year without any increase in fixed manufacturing overhead cost. The company could increase its sales by 25% above the present 60,000 units each year if it were willing to increase the fixed selling expenses by $80,000. Compute the incremental net operating income. So let's take a look at the solution. Okay, now what you see is the solution up here and then just a smaller image of the problem that you were looking at down here, just so we have the information in front of us. Alright, so to answer this question, we first calculate the contribution margin per unit. It's the $32 of the selling price given here in the problem, and then we have to subtract the variable expenses, okay, and it came out to be $18. Well, how do we come up with that? It's the sum of the 10, the 450, the 230, and the $1.20. So of these tables, the variable ones were direct labor, and I'll move the mouse out of the way here. Looks like direct $10 of direct materials, $4.50 of direct labor, $2.30 of variable manufacturing overhead, and $1.20 of variable selling expenses. So that's how we derive contribution margin of $14 given right here. Alright, now if we say we're going to have an increase in sales of 60,000 units, take the 60,000 times a 25% contribution margin, and excuse me, what was the 25%? I have to go back to the problem here. Okay, now I've slid down. The company could increase its sales by 25%, so that's why we're multiplying it by 25%. And they tell us we already had 60,000 units. Okay, so I'll slide back up here, and that's where we have 60,000 units. Increase it by 25% gives us 15,000 incremental units. We're going to wind up with an incremental contribution margin, right? $14 per unit. So incremental margin is $210,000. But there's an increase in fixed cost of $80,000. So we wind up in a positive territory of $130,000. So it looks like the increase in fixed selling expenses would be justified. Okay, now we're looking back at the original problem, and down here I've entered the text for requirement 2, which says, assume again that the company has sufficient capacity to produce 90,000 DAKs each year. A customer in a foreign market wants to purchase 20,000. Import duties on the product would be $1.70 per unit, and cost for permits and licenses would be $9,000. The only selling cost that would be associated with the order would be $3.20 per unit shipping cost. So we need to compute the break-even price on this order. Okay, now the solution appears up here in this area, this box. Here's the requirements for 2, which I've just laid on top of the original information that appeared down there. Alright, so if we want to solve this break-even price on this order, we need to solve it in price per unit. So we already know that the variable manufacturing cost was $16.80, right? $10 plus $4.50 plus $2.30. Those are our variable manufacturing costs that will be incremental to this particular situation. Then we also have to add in the import duties per unit, which was $1.70. They gave us that. And permits and licenses were $9,000. If we divide it by the 20,000 units, we can break that into a 45-cent per unit cost. And then they tell us shipping costs per unit were $3.20. Add up all the variable cost, and if you think about this, these are the incremental cost, right? And we wind up with a break-even price per unit on this incremental order of $22.15. All right, now I've put requirement 3 down at the bottom. The company has 1,000 DACs on hand that have some irregularities and are therefore considered to be seconds. Due to the irregularities, it will be impossible to sell these units at a normal price through regular distribution channels. What unit cost figure is relevant for setting a minimum selling price? All right, now on this one, I'll just talk through the answer because I don't think it makes sense to put anything on the screen. The relevant cost is right there, the $1.20 variable selling expense per unit. Okay, and that's because irregular units, they've already been produced, so production cost, including the variable production cost, at this point are sunk costs. There's nothing we can do about them. On an incremental basis going forward, those costs have already been spent. The fixed cost, the selling expense, they're irrelevant because they're going to be incurred whether or not these irregular units get sold. So depending on how the irregular units are sold, we believe the variable expense of $1.20 per unit, that may not even be relevant. It sort of depends on how it's sold. For example, the units might be disposed of through a liquidator, and then that $1.20 units wouldn't be incurred. But to answer this particular question, what's the unit cost figure is relevant for setting the minimum price with the information we have. The best information we have is that $1.20, the variable selling expense. Okay, next we look at requirement 4, which I added on the bottom of the screen. Due to a strike in its supplier's plant, the company is unable to purchase more material for the production of this product. The strike is expected to last 2 months. Andretti has enough material on hand to operate at 30% of normal levels for the 2-month period. As an alternative, the company could close its plant down entirely for the 2 months. Now, if the plant were closed, fixed manufacturing overhead cost would continue at 60% of their normal level during the 2-month period, and the fixed selling expense would be reduced by 20%. What would be the impact on profits of closing the plant for the 2-month period? Let's take a look. Okay, there's a couple ways to solve this one. The approach I usually use, even though it takes a bit more time, is to lay out the alternatives in column form. So I've got a column here that says, what do we do if we continue to operate, and what if we close the plant? And then we lay out the operating income and determine, what the differences are. So given this scenario, sales of 3,000 units times $30 per unit would be $96,000 if we continue to operate. We'd incur the $18 per unit variable expenses, right? So that's $54,000. So we've got a contribution margin of $42,000. Now, if we close the plant, of course, we don't have any of that. The fixed manufacturing overhead cost, we would record, 2/12 of that for the 2 months. Or if we close the plant, it would be 2/12 times 60%, so it comes out to be $30,000, right? We're multiplying both times $300,000. The fixed selling expense, $210,000 times 2/12 is $35,000. That's what the income statement would look like without closing the plant, right? But we would incur 80% of that, or $28,000, to close the plant. So what we wind up with is total fixed expenses of $85,000, a contribution of $42,000. So net operating income, a loss of $43,000 during this 2-month period. And if we close the plant, we would actually lose $58,000. So it looks like we're better off keeping the plant open. Okay, now here's the same answer calculated in a more direct way where we're only focusing on the incremental cost. So the incremental contribution margin that would be lost if the plant is closed was $42,000, right? And the fixed cost that can be avoided would be the $300,000 times the 2/12 times 40%. $20,000 would be avoided, and the fixed cost that was fixed manufacturing cost. Now the fixed selling cost, 20% would be avoided, right? We were going to incur 80%, so 20% would be avoided. So we take 20% times the $210,000 annual amount times 2/12, and that's $7,000. If we compare the avoidable cost of $27,000 to the margin we would be lost, we see we're worse off by $15,000, which was the exact same result we got when we compared the $43,000 loss of net operating income of continuing to operate the plant versus a $58,000 loss to close the plant. So it's the same answer, but this is a more direct way of getting there. Okay, now we look at the last requirement, requirement 5, and it reads, it's on the bottom of your screen there. An outside manufacturer has offered to produce DACs and ship them directly to Andretti's customers. So here we have the outsourcing decision, right? If the company accepts this offer, the facilities that it uses to produce DACs would be idle. However, fixed manufacturing overhead cost would be reduced by 75%. Because the outside manufacturer would pay for all shipping costs, the variable selling expenses would only be 2/3 of their present amount. And we need to compute the unit cost that's relevant for comparison to the price quoted by the outside manufacturer. So in other words, they're going to give us a price. We need to know whether it's a good price or not. Okay, now you see the solution on the top part of the screen, and on the bottom was the requirement 5 that we just read. So the relevant cost would be those that can be avoided by purchasing from the outside manufacturer. So the variable manufacturing cost of $1,680 goes away, and the fixed manufacturing cost of $300,000 times 75%, right? We're going to reduce it by 75%, means $225,000. So $225,000 times the current production volume, 60,000 units, comes out to be $3.75 per unit. The variable selling expenses, the $1.20 goes away, or how much of it goes away? I think 2/3 goes away is what they said, right? Right there in the problem. So, I'm sorry, 2/3 would stick around, 1/3 goes away. So 1/3 is avoidable, and 1/3 of $1.20 is 40 cents. Add those costs up, and we come up with total cost avoided of $20.95. So, to be acceptable, the outside manufacturer's quotation must be less than the $20.95 per unit cost here. Otherwise, if it is higher than that, it doesn't make sense for us to close this down. Now, of course, this only considers the quantifiable aspects. There may be also quality aspects, human relations concerns, environmental concerns. All of those probably need to be considered, and in this problem, we're not even laying out any cost associated with those. We would consider those as qualitative factors because we're assuming we've already identified which were the incremental cost relevant in the decision.